Okay, today we're looking at part two of my art and science of option trading. This is going to be a quick one, looking at an actual option trade. Now, the option is State Street's XLF, which is on banks. It's the banking sector ETF, finance sector ETF, but includes other finance companies. I don't know if it includes brokers, but we won't go into that too much. It's irrelevant. It's historical. It's a year or two old, the data. I left it at 30 days, the fraction. To calculate in the Black-Scholes formula, you take the difference between two dates, 30 over the number of years, 365. You can also use 250, which is the number of trading days, which will increase that slightly. It doesn't make that much difference. In the volatility formulas, I've used actual trading days. Generally for Black-Scholes formulas as continuous time, you use 365 as opposed to the number of trading days. Trading days is used for discrete, like binomial pricing models, and discrete things, where it's not continuous time. Anyway, it's a strangle. We've sold a call for 39, sold a put for 35.5. The price at that time was 38.58, and you can see that Black-Scholes figure is way off in its calculations of the price, using the historical volatility of 23%, which I didn't actually use an accurate historical volatility. I've got volatility tables here. The historical volatility was actually 22%, so I'll just change that. Let's see what changes it's made. Marginal dropped from 11 to 9 cents, dropped from 86 cents to 84 cents. And now that was the actual price at the time. As you can see, the put was way overpriced compared to the Black-Scholes model. That's the actual market price, 54%. Puts are generally overpriced more than calls because they're insurance against the downside. People pay more for insurance than they do for a chance. Calls are speculating. The upside, according to the Black-Scholes, for the call is 84 cents when in reality it was 18 cents. So Black-Scholes pricing, as I said, gives the wrong answer. It's the right method to give the wrong answer. To get the right answer, you actually have to use the actual price, feed it back in, and get the actual implied volatility. The implied volatility is a volatility implied from the actual price. Now, why do you do that, you ask? Well, because it tells you how to trade shares. Not shares, I mean options. The main way to trade options with these strategies is volatility arbitrage. There's really two basic rules. When implied volatility is higher than historical volatility, you sell the option. When implied volatility is less than historical volatility, you buy the option. So this was a losing strategy, selling the call. As you can see, the delta is 47%. You are going to lose for sure. It's nearly a break-even situation. It's nearly at the money. Even to buy back, you're going to wipe out most of the profits on the other side of the strangle. It's a bad trade. As you can see from my chart, the profit and loss at expiration, if you put down the trade at expiration, you would think, wow, I'm going to make almost $1. Or 93 cents. From the actual price, you would think you would make 72 cents, although that's even pretty iffy. It's very dependent on holding out the call, and it's unlikely. You're definitely going to make 54 cents on the put, But how much it will cost to recover the debt of the call, I don't know. So you'll write out the call at that point in time. Based on the implied volatility. Yes, you will have to buy back that call at $3.48. That will wipe out both 93 cents and 72 cents. You'll be $2 down. So yeah, there's a lesson for you. What you should trade with this situation is you should buy a call, for this side, or write a covered call. If you're going to sell it short, you need to sell a covered call to recover your money. Now, you can't write a strangle or a condor or something with this one. They have to be separate trades. Now, this put would have to be either a single short put or a short put spread if you want insurance. You would definitely make a profit either just selling a short put, because implied volatility is greater than historical volatility. On this one, you're on the right side, whereas it's a reverse for this one. Implied volatility is way under historical volatility, so you want to sell. You want to buy, sorry. You don't want to sell. And as you can see, it was losing already. So that's what you can tell when you place the trade. If this was done at 30 days, it looked like it was a profitable trade, but as you can see from the actual chart of the profit graph, it was barely breaking even at any point in time. From 38 to 39, it was barely breaking even. So it was a bad trade from the go. We'll have a bit of a discussion of, I won't go into the strategy graphs too much. Volatility. That's the variance, the standard deviation, the historical volatility. That's just the variance squared. The variance is the difference between the average and the daily price squared, summed together over 252 days as a sample. The high-low volatility is actually the Parkinson's estimator. It measures the rate of change over the period between intraday prices. The Garmin class, that's a Garmin class volatility estimator over intraday trade. It measures the high-low of the day by the open and close of the next day, of intraday trading and open close of the next day trading. Whereas these ones, what I've called the Parkinson's estimated extreme volatility, is the maximum and minimum divided by those factors. It's not truly Parkinson's estimator. I've renamed it extreme value of volatility. It's closer to the implied volatility as a quick estimator. The Garmin class volatility estimator, that's not truly a Garmin class. That's once again high and low over the year by the open and close, beginning and end of year. It's really a yearly high-low open close estimator. It's not truly the intraday Garmin and class estimator. And that's an adaptive exponential Kalman filter over the year. Kalman filters are a method which captures volatility and spikes. Exponentially weighted volatility is used for measuring VAR, as it captures the most recent price data more than the past. Both the historical, the exponentially weighted, and the adaptive exponential filter are close together, which is unusual. They don't usually match that much. The adaptive exponential and the exponentially weighted are often close together, but the historical volatility doesn't usually match. And that shows that with intraday, there's not been a lot of big spikes. There's been no clustering of extreme spikes of volatility. Although there has been quite a lot of volatility, the volatility is quite high. Anyway, that's many ways to measure volatility. Hopefully that's helped you with your option trading. You can see the delta there implies, as a proxy for the probability of profit, the put will profit, the written call, if it was a bought call, would profit. As a covered call, the call will be called away and you will make the premium of 18 cents, which isn't much. But it's a safer measure than, but just writing a naked call or writing a strangle, you lose money. So that wasn't the best strategy for this thing, and it's shown by that. So there's more to option trading than, it's a lot more complex than you think. Volatility arbitrage, I noticed I've watched Ernest Chan and Ewan Sinclair. They're two of the more honest people out there on these things. Most other people are vague, like that are option traders. They don't, or really 90% of them don't know what they're talking about, I can tell. Buying options. Really, the best way to make a profit, it's more expensive, is to buy a call in the money. Yep, that's right. If you buy out of the money calls, you will lose most of the time. If you buy in the call monies at a certain point, you will profit much the same as if you buy in the calls money with an 80% probability, you'll profit the same as writing a put with an 80% probability of success, or writing a call with an 80% probability, which this hasn't. The delta there is almost 50%. You're guaranteed to lose. I'm using delta as a proxy for probability of profit, and also as a proxy for touch probability. You just double the delta and you get a proxy for touch probability. Once you get to 50, it's almost 100%. At that point, it's 16% probability. I hope that's helpful. They're quick heuristic methods. There is formulas, which I have shown in the past, which I hope to clarify and clear up. I've shown this spreadsheet in the past, and it wasn't quite right. So I warn those who may have bought it on when I used to have a buy me a coffee site, don't rely on it. I had to rework it. And I use more robust formulas and things. Okay, thank you. Signing off. I hope this was helpful. Bye. Here is XLF a year later from the spreadsheet. I just thought I'd add this. And you can see it's not gone up much. It was $38.85 then. It's only gone up to $44.56 a year, maybe a year and a half later. But my point is here, I personally wouldn't trade it. It's not, I don't think it's quite liquid enough. But no, it's still okay. But my point is, even the puts about 20th September, that's not far enough out. Let's see here. Let's see. 30th of September, a 42 put? 42 put is 18 cents. So if a 42 put, $2 off the pace is 18 cents. Really, it's not worth investing in. The call, but it's probably all right to actually buy be okay if you want to go long. Because look, there is the implied volatility. The implied volatility is way under the historical volatility, and it doesn't look like rising much. The historical volatility is 16.9,
The implied is 11. Probably a good strategy would be to just, because I'm always into risk management. I don't like taking positions where you have to have no risk assurance. Let's see. 27th of September. Maybe buying in the money. Let's see. Oh yeah, that's okay. You can buy at 45. $45. You could sell a $45. We'll go up a bit. You could sell the $45 call and buy the shares for $44.56. You'll make 54 cents on the premium, and it'll be exercised probably in a week or so, because it'll reach. Will definitely be exercised by the end of by 30th of September. You'll reach. You'll get the price is at $45.56, so you'll get 44 cents on the share when it's exercised, and you get 54 on the premium of the call. So you'll make nearly $1. You'll make $1 on the, not quite $1, 98 cents on the times 100. So you make $98 on the trade. It's not a bad trade for a covered call. So yeah, it is okay. And a covered call is a risk-assured trade. You're covering both sides. Rather than just buying the shares outright. But for those who are brave, you can just buy the shares outright. Anyway, this was just to add to the end of our discussion to show where it's at now. And the IV. I can just go down. The IV spike drops right down. You can see even though it's coming down, the historical volatility, it's still got a while to converge. It'll probably converge about there, about the 13th of September. So about maybe that point you might want to exercise it when it's over. When it's over $45. Anyway, signing off.